Gold in 2026. Do you need it or do you have to have it? Let me start with something simple. Most people still think of gold like a spare tire, something you keep in the trunk, hope you never need it, and forget about until the car starts shaking. But in 2026, that view is changing, and it's changing fast. See, gold is no longer running on hype. It's running on structure. Let's cut through the noise and explain why analysts are forecasting higher gold prices in 2026. This rally isn't about momentum. It's not about fear or negative headlines. It's not about speculation. It's simply about structure. Here are the top 5 structural stories behind the gold forecast in 2026. Number 1, supply is tightening while production costs are rising. See, this is an underappreciated piece. Gold miners aren't flooding the market with new gold. And Bank of America estimates that major North American producers will actually produce less in 2026 and not more. Number 2, we still have a broad-based demand from investors, central banks, technology, and even jewelry, although there are some cyclicalities influenced by Middle East, Asian market, and Indian market. Number 3, what we're seeing is that gold is becoming very sensitive to interest rate changes. See, historically, gold tends to outperform when interest rates starts to drop because the opportunity cost in investing in gold becomes less. Think of it this way. When your bank starts paying you less in interest, and if you factor in inflation, a lot of investors are saying, why should I invest it in a CD when it's paying me 3% and inflation is 3%? Number 4, geopolitical uncertainty. Where do we start? Venezuela, Latin Americans, Greenland, Russia, China, and Iran. There's instability across multiple regions. And whenever that happens, we see the flight to safety, and there's a lot of movement back into gold from a lot of risky assets. Number 5, we still see low allocation in portfolios. Even with a historic rally in gold in 2024 and 2025, most investors remain under allocated in gold. What does that mean? It means that inflows still have a lot more room to grow. Now remember, in the third quarter of 2025, Morgan Stanley came out and adjusted their standard portfolio of 60-40, 60% in stocks and 40% in bonds, to 60% in stocks, 20% in bonds, and 20% in gold. Notice how stocks remained at 60%, which simply means that money moving into gold is coming from bonds. See, that is the money simply moving from assets that appear to be liquid, appear to be yielding, into an asset that actually holds value, is appreciating, and is performing much better than bonds. See, precious metals, specifically gold and silver, are like the alpha wolf. They're leading the pack. And this is where the narrative is really changing. Like I said, gold is no longer just an insurance. As a matter of fact, Bank of America explicitly calls gold both a hedge and a source of alpha. It's an alpha, meaning it's actually enhancing returns. It's driving returns. And that actually matters because the bankers are behind it. Gold isn't just there to soften losses anymore. It's contributing, and as a matter of fact, improving returns. Historically, during easing cycles, even when inflation is mild, let's say it's around 2%, gold has averaged about a 13% return in the last 25 years. And here's the kicker. You don't need rate cuts at every Fed meeting. You just need rates going down because gold listens to the direction, not to the promises. Now, with that being said, let's go over the forecast of 2026. By the way, we put together a list. We looked at all the top 25 analysts, from your favorite bankers to unknown bankers, and we want to share this information with you. Click on the links below. Just request the information. There's no obligation, no commitment. We've put hours of research, and we want you to have that resource so you understand that this is not about a hype. This is not about a speculation. So why don't we start? Number 1, Robert Kiyosaki. Robert Kiyosaki is the author of Rich Dad, Poor Dad, and he's forecasting gold at $25,000 in the year 2026 and silver at $70. Well, guess what? He already hit the $70 on silver. But let me read you his quote. Here's what he said. Good news. Gold will go to $25,000 and silver will go to $70. If you ask me, I think that's an aggressive forecast. It's actually 5 times more than the average bank analyst forecast. Maybe Robert Kiyosaki knows something that we don't. But be careful. Do not make investments because someone is throwing a number. That's one of the most common mistakes that a lot of first-time investors make. Your job is to understand what are the fundamentals. Does it make sense? And once we cover all the forecast, we're going to determine what is that sweet spot so that way you have a lot more confidence with the numbers. Number 2, let's go to Jim Rickards. Jim Rickards is saying $10,000 gold in 2026. Some of you know who Jim Rickards is. He has published many books, ex-CIA insider, an economist. Let's read what he had to say. In a recent interview, Rickard explained that he would not be surprised if gold reaches price of $10,000 and silver following with $200 in 2026. And here's the quote. He said, if you're Saudi Arabia, Japan, Taiwan, or Brazil, or any large holder of U.S. Treasury securities, you're looking at this and saying, hey, what if the U.S. doesn't like something that I do? Maybe I ought to diversify into gold. All right, let's move on to a chief investment strategist of Bank of America's Merrill Lynch, Michael Hartnett. He's forecasting gold at $6,000 an ounce. Here's the quote. History, no guide to future, but average gold jumps past 4 bull markets, approximately 300% in 43 months, which would imply gold reaching $6,000 by spring next year. All right, let's move on to number 4, JP Morgan. Gold remains our highest conviction long for the year, and we see further upside as the market enters a Fed cutting cycle. They're forecasting $5,055 for the year. Now, many of you have seen an interview where Jamie Dimon, the CEO of JP Morgan Chase, which, by the way, when he speaks, Wall Street listens, he basically said this. Let me read you the quote so that way I get it right. He mentioned that he thinks gold could reach $5,000 to $10,000 in the current economic environment. All right, folks, these are bankers that move trillions of dollars on a daily basis. Think of them like the insiders of the banking giants. They see how much money comes in, how much money goes out, which of their clients are not able to make their payment. They see where money is flowing. See, where energy goes, money flows. So, and one thing about JP Morgan specifically, they are the custodian and the administrator of the SLV, the ETF of silver. They know a thing or two about commodities, gold and silver specifically. Let's move on to Bank of America, in addition to their strategists. Here's another quote. The White House's unorthodox policy framework should remain supportive for gold given fiscal deficits, rising debt, intention to reduce the current account deficit capital inflows, along with a push to cut rates with inflation around 3%. Here's my favorite one. In gold we trust. The reason why they're one of my favorites, very detailed information. Every May they come out with a report, and for the last 3 consecutive years, their forecast, their insight has been on point. If you're seriously considering learning a lot more about gold in general, and if you want to have somewhat of an unbiased perspective, I highly suggest visit their website. We're not affiliated. This is not an endorsement. I simply like their content, and I urge a lot of people to read it. In gold we trust. Here's one of my favorite quotes. We're now witnessing how a secular bull market is slowly becoming mainstream. Look, their forecast is 5,000 plus. Let's move on to Yardeni Research. You might know Yardeni Research from many Fox Business, CNBC. He always comes out and forecasts what's happening into the market. And here's what he had said. Our 4,000 target by the end of this year, 2025, looks increasingly realistic. If that happens, then 5,000 would be our target for the end of 2026. Let's move on to State Street. State Street, they're forecasting 5,000. By the way, State Street are the ones that actually started the ETF GLD. Like I said, they know a thing or two. Gold could possibly scale 4,000 to 5,000 in the next few years under certain macroeconomic conditions, such as stagflation coupled with accelerated de-dollarization. Oh boy. All right. What do we mean by de-dollarization? I can speak about this for hours and hours. Put simply, the world is starting to use less dollars. You can look at the IMF data points. Back in the year 2000, we were controlling roughly about 73 to 80% of global trade. And as of 2025, we had about roughly 53 to 60%. That is a trend, which means there has been a rise for alternative payment sources. See, here in the US, we have an entire ecosystem from the IMF to the SWIFT to the Federal Reserve, the COMEX. We have all those pipelines of money and commodities. In the last few years, we've seen a shift towards Asian market led by China, the Shanghai exchange. Also, Russia's having their own exchange. Instead of having the International Monetary Fund that lends money in dollars, the BRICS alliance, Brazil, Russia, India, China, South Africa, they're actually utilizing local currencies. So little by little, we're seeing a movement away from the dollar into the alternatives. That's what this concept of de-dollarization means. Let's move on to Societe Generale. 5,000. Flows into gold-backed exchange-traded funds have surpassed its initial assumptions. Let's move on to Metal Focus. They're also forecasting 5,000. Here's another quote. Trade tension, inflation risk, and fragile confidence should sustain safe haven demand, while fiscal stains and doubt over the Fed's independence curb the dollar's appeal. Even if the interest rates cut are less aggressive than market expects, lower yields, geopolitical tensions, and ongoing official sector buying should drive fresh record price highs. Wow, that was a mouthful. In a nutshell, so far what we're seeing is that a lot of bankers are basically quoting the same thing. Capital is moving away from the dollar. They anticipate the Federal Reserve to make adjustment to the interest rates policy. And by the way, they said this before the federal government is investigating Jerome Powell. The concept of Fed independence is actually going to be exasperated. So we do anticipate a lot more volatility. Let's move on to a couple more banks. Goldman Sachs, 4,900. Here's the quote. We see the risk to our upgraded gold price forecast as still skewed to the upside on net because private sector diversification into the relatively small gold market may boost ETF holdings above our rates implied estimates. See, if you compare global stocks or global bond market to the gold market is roughly about $30 trillion based on the recent spot price. Of course, relative to that, it's small. But if you look at the silver market, you're looking at much smaller market. So we'll see what their forecast is on silver. Stay tuned. UBS, 4,900. UBS analysts have an upside target for gold of 4,900 per ounce in 2026 due to a potential spike in political and financial risks. The bank's analysts expect the worsening U.S. fiscal outlook to boost central bank and investor gold purchases, and that demand for exchange-traded funds will remain strong in the next year. Morgan Stanley, 4,800. Morgan Stanley forecasts gold prices will reach 4,800 an ounce by the fourth quarter of 2026. The firm attributes this to a stronger Chinese retail demand, increased central bank purchases, and rising global growth concerns. Folks, I'm not going to read you all the quotes because in the resources you have all that. We give you the sites, we give you the resources, something that you can verify. Let's talk about a bank that is forecasting gold below 4,000. You have World Bank. They're forecasting gold at 3,575. Here's what they did. They took their average forecast of 2025 and they basically multiplied it by 5%. Now, here's what they said though. Precious metals is increasingly aligned with the global factor, driven by heightened geopolitical tensions and inflationary pressures, which boosted demand for safe haven assets like gold. Folks, here's the bottom line. A lot of these banks and analysts and economists, they look at the data at a specific point in time, and they have their assumptions. Now, the forecast is as good as this assumption. If there's good information coming in, then there might be good information coming out. With that in mind, when you think about the forecast, and the way I would look at this, I'm not looking at the most aggressive $25,000, okay? I'm looking at the logic. What is historical performance that can give us a little bit more confidence in our forecast? And by the way, this is not a financial advice. I'm sharing with you my personal opinion of how I think gold could play out in 2026. I would take the year-end value. Let's say gold ended 2025 at about 4,300. And if you multiply the average return in the last 25 years, that's roughly about 13%. Let's go ahead and increase that to about 15, and there are some specific reasons. 15% at 4,300 year-end, then the growth will yield roughly about 5,000. So if you ask my personal opinion, I feel very comfortable forecasting gold at 5,000. However, there's a lot of factors that will influence it, as we had discussed. What matters to you is this. When you're looking at these forecasts, take it at face value. Now that we went over the list, obviously it is very evident that overwhelmingly, majority of the banks and analysts are forecasting gold above 5,000. Now, the way I would think about it is this. If the Weather Channel says that a major storm is coming, nobody argues about whether it's going to rain 3 inches or 4 inches. You don't debate the speed of the wind. You prepare. You move things inside. You stock up because you don't want to wait to see how bad it's going to get after the damage is done. What do I mean by that? Well, that's how I think about gold forecasts. You have analysts that can agree, disagree, whether it's going to be 4,300, 4,500, 4,900, or 6,000, or even 25,000. But they all see the same thing on the radar. Gold isn't a bet on how hard it rains. It's your financial raincoat. And here's what I want to leave you with. In calm seas, anchors don't matter much. But when currents shift and visibility drops, an anchor isn't optional. It's essential. Gold heading into 2026 isn't about predicting a disaster. It's about acknowledging the structure. Supply is constrained. Policy is becoming uncertain. And you have portfolios that are under-allocated. And gold is quietly doing what it always has done. It's holding steady while everything else recalibrates. Folks, that's not fear. That's foresight. If you value a firm where they lead with education, build a relationship based on full integrity and transparency, click on the link below, have a conversation, get your questions answered, so that way you have the confidence in making the right choice.